Steven, great to have you with us. Let's start by talking about cost cuts. When does it end?
So, I mean, they outlined actually within the Q&A portion, it wasn't in any of their prepared remarks, but Brian did reaffirm that the $53 billion expense goal, which does incorporate some additional cuts in 18, that they can actually sustain that level through 19 and 20. And in my mind, it's really going to be funded with continued efficiency savings, the focus on digital. You make those investments in technology, but just drive greater efficiency longer term. And so as we think about the setup here, it's really quite positive in that the street's giving credit for those cost-cutting initiatives in 2018, but they're not giving the credit beyond that. And as you think about the long-term investment case here, that's really where we see the most upside.
Well, Steven, speaking of the long-term investment case, I think most people at this point see a lot of upside for Bank of America, and I'm wondering what's in the price. I caught up with Gerard Cassidy of RBC Capital Markets on that particular topic. Take a listen to what he had to say.
The real conviction stock, Bank of America, because it's a very attractively priced amongst the largest banks, followed by Citigroup and then JP Morgan. All three of them should do well throughout the year if the trends we saw this quarter continue based upon the rise in rates and the stronger U.S. economy.
Steven, isn't this the consensus view on this stock, and do you worry that it's a bit of a consensus view?
So I think on the rate side, it is a consensus view with regards to U.S. domestic gearing, higher rate sensitivity at BofA. But I still believe that if you look at numbers, the lower deposit beta and the room to surprise positively on NII is underappreciated. And it's really the expense and credit stories where we actually see the most upside potential. I would agree that both JP and Citi are relatively cheap. The difference is there is no positive revision story there, whereas you look at BofA and the potential to surprise positively, not just on NII, which I think is better understood, but expense and credit as well, I think it's going to drive continued outperformance. I mean, this is a company that should earn $3 in 2019 and trades at less than 10 times that number.